Hello and warm welcome everyone to today's webinar. I'm Michael Lookman from Gen Advisory. I will be your host for the next 45 minutes. Now, for those of you who are dialing in from Australia, where Clement and I currently are, a very good evening almost to all of you. And for those dialing in from Jakarta, where Andrew and Paul are, very good afternoon to all of you. So in the course of my presentation today, I will be covering each of these areas. I will start off by providing a bit of background and context to today's webinar before the four speakers then go through each of these areas, starting with the Australian FinTech landscape, its Indonesian equivalent, the Catalyst program, and a bit of a Q&A session for all. Now, for all speakers, an overarching objective, which should guide all of us, is that we will be balanced. And by that, I mean we will neither over nor undersell the Australian or Indonesian fintech sectors. Rather, we will be open and transparent about what we view and what we consider to be the challenges and opportunities that both sectors present. Now, a bit of housekeeping at this stage. We would like this session to be as interactive and engaging as possible. So we do encourage everyone to ask questions throughout via the chat function. You can ask them, you don't have to wait until the Q&A section to ask those questions. You can ask them as they come up at the appropriate point in the presentation. And we depending on time, we will either answer them on the spot or wait until the Q&A section at the end to respond. Okay, so if there are any questions, please ask them via the chat. So to provide a bit of background and context to today's webinar, I have been planning this webinar for several months now, and for two reasons. One, because I think that this is such a fascinating topic. I think that Australian and Indonesian fintech sectors represent, provide an excellent case study in a mature and a developing jurisdiction, respectively. And secondly, because the second reason being, I had heard and observed for myself that following the election of the current Labour government in Australia, there has been a bit of a renewed focus and momentum on the Indonesia-Australia bilateral relationship. Now, I wanted to capitalize on this momentum for the benefit of the fintech sector of both jurisdictions. So now my two speakers today, Andrew and Paul, I had invited to speak based on their respective areas of expertise. Andrew has been based in Indonesia since 2014, where he has worked for such organizations as Herbert Smith Freehills, Sinar Mas, and Blue Visions. So yeah, he's very much of an Indonesia expert. Paul, on the other hand, is the director of Catalyst. Now, whilst Catalyst is neither a fintech-specific program nor a grants program, my view is that it is beneficial for fintechs of both jurisdictions which meet the qualifying criteria. So I'm very grateful to Paul and Andrew for having accepted my invitation to speak today. In terms of the webinar attendees, we do have a nice broad cross-section of fintech from both jurisdictions, ranging from those at the earlier stage, the earlier stage fintechs, right up to those which have reached unicorn status. We also have representatives from FinTech Australia, FTech, and DFED Jakarta in attendance today. So on behalf of Gen Advisory, I'm very grateful and humbled by the support that my little event has attracted today. So yeah, the last thing I wanted to comment before I move on to the next section is this. I am very conscious that we are in a very challenging environment. So for a lot of fintechs, things such as capital raising and runway conservation have probably taken precedence over international expansion at this time. Now, whilst acknowledging that, Gen Advisory and I are still seeing, even in these subdued times, still seeing international expansion activity. And our view is that, international expansion is not a transactional event. It's not a transactional event. It is something that requires a long-term view. Okay, so I might pause there and see whether we have any questions. Excellent. Okay. So that's a no at this stage. So I will move on to the next section. We shall begin. So starting with the Australian FinTech landscape. So to provide a bit of a snapshot, according to the latest statistics from KPMG Australia, as of October last year, there were 775 fintechs operating in Australia, which is an 8% increase over the same period last year. Now, by international standards, that's a relatively large number, especially considering Australia's size and population size. Now, for the Indonesian fintechs thinking of entering the Australian market, this could mean two things. One, it does mean that you do have a high level of competition, which is true. But on the flip side of that, you do also have these could represent your potential partners and also your potential consumers. Due to its growth, the Australian fintech sector has now become almost a customer segment in its own right. Looking then at the fintech sector at a more granular level, according to the latest EY FinTech Australia census report, within Australia, the most popular category of for fintech in Australia is the payments and wallets category, and the second most popular is business lending. And later on in my presentation, I will highlight that these two areas have been and continue to be growth areas within fintech in Australia. Turning then to the regulatory side of things, this slide summarizes the key regulators that are applicable to fintechs that are operating in the financial services space. Now, so what I want to highlight there is, now for the benefit of Indonesian fintechs who are considering entering the Australian market, as an ex-regulator myself, my recommendation there would be for you to have a proper understanding of the mandates of each of the regulators that you're dealing with, and structure your conversations and your regulatory strategy accordingly. Now, from a market entry perspective, for those of you for Indonesian fintechs entering the Australian market, the regulator which has a mandate that's most conducive to market entry would be Treasury. Now, turning next to recent success stories. This slide then summarizes the Australian fintechs in Australia which have achieved success in recent years, and by that I mean fintechs which have achieved unicorn status. What's worth noting in this slide is that one of the unicorns, Afterpay, had previously had operations in Indonesia by virtue of its ownership stake previously, by virtue of its ownership stake in Empat Kali. Okay, turning then to growth areas. As I had highlighted before, we have seen and continue to see payments and business lending as being key growth areas within Australia. In Gen Advisory's view and based on our research, we believe wealth tech, RegTech, and AI-enabled technologies will continue to be growth areas and in this country. And in the Q&A section, I'll be more than happy to provide detailed reasons as to why we believe these areas will be growth areas in Australia. Now, in this section, I really wanted to spend some time on highlighting the challenges and opportunities because that we had promised there had been a core component of the agenda for today. So I would like to spend a bit of time on this. So in terms of the challenges and opportunities for market entrants, I have divided them, both categories into the challenges and opportunities into regulatory related issues, challenges and opportunities, and market related ones. And I will now go through these in turn. So starting with regulatory challenges, I think the biggest challenge which we are going to be open and transparent about as an ex-regulator is Australia is a jurisdiction that has a high level of regulation. It is a highly regulated environment. So for fintechs from all jurisdictions coming to Australia, this has been a pain point and at times a deterrent. So fintech from Indonesia coming to Australia would be no different. You would face the same challenges and concerns. So from a regulatory perspective, I guess as an ex-regulator, this is the way I describe it. There is always a bit of tension and a bit of a spectrum between consumer protection and financial stability on the one hand versus innovation and market entry on the other. Right, there is always a bit of tension between the two and a bit of a spectrum in which way you lean. In our view, the Australian sector is one where it is very much leaning towards the consumer protection and financial stability end of the spectrum. So and so for fintechs, we're striving for growth and innovation, that at times has been a pain point and a deterrent. Now, on the flip side, however, what we have observed is that whilst the regulatory environment has provided challenges, it has also presented certain opportunities, which I'll run through now. What we've seen and heard within the industry is this tough regulatory environment that Australian fintechs faced has had a benefit of promoting Australia as a safe jurisdiction. History has shown that Australia's tough regulation during times of economic distress have served both not just the Australian population well, but also its financial participants well. Because even during times of economic distress, financial participants, financial players and providers in the industry in Australia have continued to enjoy healthy profits. So I guess for the benefit for Australian fintechs who are in this audience, who are willing and able to withstand the high costs and become licensed in this jurisdiction, if you're willing to undergo and have the ability to withstand those things, then you would have the benefits of incumbency. You would leapfrog over other participants who do not have the means to do so. Another benefit of Australia's tough regulatory environment is that, yes, it is also conducive for fintechs which have international expansion aspirations. Having the Australian license and Australian operations is looked upon favorably in overseas jurisdictions. Turning then to the market-related challenges and opportunities. What I wanted to highlight here, I think the challenges that I'm going to highlight will not come as a surprise to most in this audience. But what I hope is apparent is that for all the challenges that I've highlighted, there are also a corresponding opportunity, and I'll go through these in turn. I think it comes as no surprise to most people that yes, that a binding constraint within the Australian market is that Australia, with its population size of 25 million people, has a relatively small population. And so that does limit in terms of the business to consumer market, that does impose certain constraints. The flip side to that, however, on the opportunity side is, despite that, we are still seeing fintechs which have compelling offerings, even the B2C market, still able to carve a useful niche for themselves in the Australian marketplace. Another opportunity is, yes, I guess in terms of relative strengths, we would see, whilst the B2C market has its constraints, like I said before, Australia, a relative strength for Australia is the B2B market. Another challenge within market-related challenge in Australia is, as should come as no surprise to most people, Australia is a high-cost jurisdiction. It's expensive to operate in. But the flip side to that is, yes, it is also a high fee jurisdiction. So fintechs fintechs for Indonesia, for example, operating in this space would enjoy on average higher value transactions, average higher value transactions that you would in the Indonesian market. Another main key challenge in the Australian market is long procurement cycles. Now, what we've heard and observed is that the larger your target client, particularly in the financial services space, the larger your target client, the longer procurement cycle. So, and that's something we would highlight to prospective market entrants. The flip side to that is now there is an opportunity for fintechs which have long runways, which have long project operating runways. So in totality, considering all the challenges and opportunities that I've just highlighted, in my view, if you were to ask me, is Australia still an attractive destination for prospective market entrants? On balance, having highlighted all the things we've talked about, my view is yes, it's an unequivocal yes. With that, with the proviso, with the qualification that we do recommend that fintechs who do enter this market have the necessary runway to ensure, to withstand the time required in order to achieve market traction in this jurisdiction. Okay, so that brings me to the end of this section of the webinar. I will pause here and answer questions. We have 7 minutes to our next section, so I'll throw it open to questions. Turning to the Indonesian landscape. So according to the Indonesian, so within the, to provide a bit of a snapshot of the Indonesian fintech sector, according to various reports, the number of fintechs in Indonesia as of last year, the number ranges from somewhere between 350 to 400, depending on which report you read. So I guess relative to the Australian market, we do see that there is some scope for further expansion and further growth in this country. Based on statistics provided by FinTech, who's according to the latest report, this is the breakdown. And yeah, one similarity there is the most common category for fintech in Indonesia is similar to Australia, payments. The second being lending, with a slight difference in that, well, as in Australia, the leaning is towards the weightage is towards business lending. In Indonesia is more weighted towards consumer lending. In terms of regulatory agencies, the two most applicable regulatory agencies that govern fintech in Australia would be firstly OJK, and second being Bank Indonesia. But it's also worth noting that the Ministry of Communications and Informatics also at times produce publish guidance and legislation that is applicable to fintechs operating in Indonesia. At this stage, I will then turn you over to Andrew, who will provide a bit of a regulatory update on the legal environment applicable to fintechs in Indonesia. Over to you, Andrew.
Yeah, thanks, Michael. So I'm going to give a very general overview of some of the recent changes or the recent things that we've seen in the Indonesian fintech market from the legal perspective. For some of you that are in Indonesia, it may be oversimplified, but I think there's certainly some value in retouching on some of the steps. And I think based on what we're seeing, the fintech sector in Indonesia continues to be very active, and most of the transactions that I'm seeing relate to fundraising and bolt-on acquisitions, which expand on the product offerings. The other types of transactions that I'm seeing are commercial collaborations and consolidations between similar or competing fintech companies. I think the other thing that we're seeing in the market is that a lot of the first generation fintech companies are maturing, and as they mature, the shareholders of some of these companies have started to look to exit or look at exit strategies, whether that's via M&A or IPOs. And some of the recent IPOs that have occurred, being, for example, Bukalapak and Goto, two of the larger ones. The other thing that we're starting to see is that the increasing depth in the market is being reflected in the increasing level of sophistication of the regulatory framework here in Indonesia. And although it's true that the technological innovation here in Indonesia is sort of outpacing the regulatory framework, OJK in particular, and the Indonesian government as a wider organization is increasingly trying to implement new regulations to catch up, I guess, with the fast-paced fintech sector. And the way that they've done that for some of them is to include or to introduce sort of very general and broad regulations, which can be interpreted to cover things as they change, and then bringing in implementing regulations to target specific things as and when they feel that it's appropriate. I think we can go to the next slide, Michael.
Yep.
So for the purposes of today, I don't propose to speak about all of the fintech laws and regulations. I just wanted to touch on some of the things that I think may be relevant to the people that are attending the call, but also ones that are at the forefront of what we're seeing at the moment. One of those, and the first one I'll discuss, is digital banking. And in relation to digital banking, we started to see the consolidation or the acquisition of some of the smaller banks going back as far as about 18 months ago. There was an Indonesian government mandate, whether it was formal or informal, to consolidate some of the banking licenses, because the Indonesian government was of the view that there was too many banking licenses here, and to shore up the banking system, they were trying to reduce the number of banking licenses and get some of the smaller entities to consolidate. In particular, in relation to digital banks, we were seeing a lot of investors, local and foreign, looking to acquire some of the smaller traditional banks in Indonesia and then convert them into digital banks. And I'll discuss the reason why they were looking to acquire them as opposed to setting them up from scratch in a minute. But in July of 2021, OJK revised the commercial banking regulation, which is the regulation that applies to commercial banks in Indonesia, to reiterate that they won't be issuing a digital-only banking license. So based on the current regulations, digital banks are covered under the existing prevailing regulations that apply to commercial banks, except for, in some circumstances, things like exemptions which apply for the use of non-Indonesian manpower in certain situations for digital banks. Those still apply to the traditional commercial banks, but digital banks are exempted from that, in addition to some others. So basically, OJK, as I said before, has been, and the Indonesian government have been very supportive of the acquisitions, as in their view, it's helping to strengthen the capitalization of the banks, the target, or the smaller banks, but also the financial sector as a whole. Under the current framework, if you want to set up a digital bank may be created through either the establishment of a new commercial bank that's operated as a digital bank, or the transformation of an existing commercial bank into a digital bank. And given that the minimum paid up capital to establish a new commercial bank is about 10 trillion rupiah, and the minimum core capital that you need for an existing bank is about 3 trillion, there's been a preference, obviously, from foreign investors to acquire existing banks and convert them into digital banks. And we expect that trend to continue. Under
Next slide.
the sorry,
Yeah, keep going,
under
yeah.
the commercial banking regulations that was issued by OJK, they have categorized banking products into two types, being basic banking products, advanced banking products, which include IT-based products and services, which extends to cover some of the services provided by digital banks. I think importantly, one of the questions that was asked prior to the seminar today was whether foreign investors can own a controlling interest in an Indonesian bank, and I can confirm that it is possible to structure the acquisition or the ownership so that the foreign investor owns a controlling interest in the Indonesian bank. We expect that the M&A and consolidation in this sector will continue to expand, and we note that some of the existing local Indonesian digital banks are looking for foreign investors to help them shore up and then give them more access to capital as they continue to roll out. Michael, can you go to the next slide? I might talk a little bit about the e-payment regulations now. So as Michael mentioned, the e-money and the e-payment side of FinTech has been gaining popularity in Indonesia, and I think digital payments remains Indonesia's largest FinTech sector, which I think is around 40 to 45% of the FinTech companies in Indonesia. So 40 to 45% of the FinTech companies in Indonesia comprise of some sort of payment service provider. In 2020, Bank of Indonesia enacted a regulation which was intended to set out a basic framework for the payment system industry, which was effectively the umbrella framework. Following that umbrella framework, Bank of Indonesia issued a further 2 regulations, which I'll refer to as the PJP regulation and the PIP regulation. Now, the issuance of these 2 regulations further strengthened the end-to-end Indonesian payment ecosystem by dividing them or classifying those players into 2 different categories, being payment service providers, PJPs, or payment infrastructure providers, being PIPs. So in terms of the front end or the PJP activities, they're classified into 4 types. So you have accounting information services or provision of information on source of funds, payment initiation or acquiring services, account issuance services or administration of source funds, and remittance services. There are generally 3 types of categories of PJP license that are issued. The category 1 license covers all of the PJP activities that I mentioned. Category 2 license, which covers only account information service and payment initiation and or acquiring services. And the category 3 license, which covers only remittance services and other services that may be stipulated by Bank Indonesia. The back end or PIP activities, which cover clearing and settlements activities, are covered by a different license. So any FinTech that's coming in to set up their own business that isn't partnering with somebody else that has an existing license is going to have to go through the process to apply for and acquire these licenses before they can operate in the e-payment sector. Another part of these regulations, which is important to foreign investors in particular, but also worth knowing for local Indonesian investors and companies, is that these 2 regulations reiterate the domestic shareholding and control tests, which need to be satisfied by PJP and PIP companies. These were originally introduced in 2020 by Bank of Indonesia, but were reiterated in the PJP and the PIP regulations. And basically, these set out that at least 15%, direct or indirect, of the total shares in a non-bank PJP must be owned by Indonesian shareholders, and at least 80% of the total shares in a non-bank PIP must be owned by the Indonesian shareholders. It is arguably possible to structure the shareholding so that the foreign investor notwithstanding that they don't own a certain percentage of the shares, still own certain rights in respect of control and dividends. But again, that's something that needs to be discussed on a case-by-case basis for each of the investments or each of the joint ventures that is going to be entered into. In addition to the 15% that's required to be held by local Indonesian investors or local Indonesian shareholders, at least 51% of the shares with voting rights in a non-bank PJP must be owned by Indonesian shareholders, and at least 80% of the shares with voting rights in a non-bank PIP must be owned by Indonesian shareholders. And also certain rights must be held by Indonesian shareholders as well. And the single largest shareholder in a non-bank PJP with voting rights must be an Indonesian shareholder. So this is important because a lot of the other sectors in Indonesia or business lines in Indonesia were recently opened up to foreign investors, but this is one sector which still has fairly detailed foreign investment restrictions. In respect of it, and their shareholding structure, I should say, in place prior to the introduction of these regulations. Those structures are grandfathered in place and are exempted from these shareholding and control test requirements unless and until there's a change in the shareholding. So, for example, if your existing structure was in place, shareholding structure was in place before the regulation was issued, you don't have to make any changes, so long as you don't change that shareholding structure. If you get another investor coming in, whether that's local or foreign, then automatically by operation of the change in the shareholding, you would be subject to the regulations and have to comply with the regulations. I might move on to peer-to-peer lending now. Michael, if you could just go to the next slide.
Yep.
So this is potentially the most recent change, I think, in terms of the fintech sector. OJK introduced the P2P lending regulation, which became effective on the 4th of July of last year, which replaced the existing P2P regulation that was in place. And I won't go through the whole regulation as such, but I'll just sort of touch on some of the important issues that were included in this regulation. And the first one is the minimum paid up capital requirements. And that's that P2P operators must have a minimum of 25 billion Indonesian rupiah paid up capital at the time of establishment. But again, there's also a grandfathering similar to the one that I just mentioned for those that were in place or had their license prior to the introduction of this regulation. The other important point that was covered in this regulation was the introduction of a fit and proper test for key parties, which is something that has been in place for a long time in jurisdictions such as Australia and continues to be applicable there in a number of different industries. Under the new regulation, the fit and proper test and OJK approval is required for key parties of the P2P operator. And the key parties in this context consist of the controlling shareholder, each of the members of the board of directors and the board of commissioners, and if it's a Sharia product, members of the Sharia supervisory board. So if you're coming in to establish a P2P lender, or you're going to buy one, and you're going to introduce your own members of the board of directors or board of commissioners, you're going to need to be aware of this particular aspect of the regulation to make sure that all of those parties, or all of the parties from your side, are going to be able to comply with and satisfy these tests. Again, I think the challenge will be for foreign investors who quite often require an Indonesian representative to sit on the board of directors or board of commissioners, will be trying to find that person or trying to find that representative. But it's not impossible. It's just something to keep in mind, and it's something that that your local Indonesian partner or your advisors, your Indonesian legal advisors or commercial advisors, may be able to assist you with. So the other aspect that I want to discuss relates to a change of shareholders and a lockup period. So the new regulation requires that any change of ownership in a P2P operator must be approved by OJK and that includes the ownership of a P2P operator that's not a listed company, a shareholding in a shareholder of a P2P operator who is not a public company, or a P2P operator who is a public company, controlling shareholders in P2P operators who is a shareholder in a public company. So this is similar to the previous regulation that the Indonesian government had in place in respect of changes to BOD and BOC for mining companies. Again, it's not impossible, but it just creates an additional layer of administration or red tape in respect of the change to the shareholding. At this stage, it's not clear to us what would cause OJK to reject the change in ownership. Again, it would need to be done on a case-by-case basis. But it does introduce a layer of complication in relation to potential shareholding changes or joint venture M&A. So, for example, if you're entering into a conditional sale and purchase agreement for the addition of a new partner into the joint venture, then as a part of that documentation, you're going to need to include a condition precedent that the change of shareholding is approved by OJK. I think we can go to the next slide, Michael.
Yep.
Sorry, can you go back to the previous slide for me?
Right.
No, the next one, mate. The peer-to-peer lending.
That's this one or the next one? This one?
Oh, that'll do. Yeah. No,
Yep.
That's this one will do. The other thing that I wanted to touch on is the new minimum equity requirements that were introduced. So P2P.
Andrew, you've got 3 minutes.
Yep, that's okay. The P2P operators are now required to maintain a minimum equity of 12.5 billion, which must be complied with in the following stages. Now, I won't read out what they are as they're on the screen for you to see, but you'll notice that there's staggered in terms of the minimum equity requirements that are required to be complied with. So you've got a certain period of time within which to comply with those. Michael, can you take us to the next slide, please? The slide that talks about the lending limits.
That one?
Yeah. So
Got 2
potentially,
minutes, Andrew.
yes, this one. Yep, this will do. So one of the more important changes points that was introduced in this regulation was the introduction of these legal lending limits. And it's important for P2P lending platforms to understand this. So the new regulation stipulates that the maximum lending limit for each borrower is 2 billion. And in addition, the new regulation now also regulates the maximum legal lending limit for each of its lenders and its affiliates. And it sets that out as 25% of the total loans dispersed by the P2P operator at the end of each month. So, for example, if you're a P2P lender and you've got 100 million in loans, then each lender is only, or the maximum for any one particular lender is 25% of that 100 million. So how that's monitored, I'm not sure, but that's the requirement that sets out under the regulation. There's also additional maximum lending limits for the lender, and you'll note that those are applied in stages. So for the 6-month period commencing from the 4th of July, the lending limits at a rate of 80% of the lending dispersed at the end of the month. For the 12-month period commencing from the 4th of July, the lending limit is a rate of 50% of the lending dispersed at the end of the month. And within 18 months, the lending limit is at the rate of 25% of the lending dispersed at the end of the month. Now, the regulation is quite clear in what the requirements are, but I think from an enforcement perspective and a supervisory perspective, we're not sure yet whether it's going to be self-reporting or whether the regulator is going to be active in confirming compliance with all of these. It's important to note that given the limited amount of time that I've had today, I haven't been able to cover all of the relevant points in the regulation. And if you're intending to operate or you already operate in this sector, I recommend that you read the regulation or get your legal advisors to read the regulation, as it's got a number of other provisions which are also quite important. But I seem to be running out of time, so I might just hand back to you, Michael.
Thank you, Andrew. And yeah, so thank you for covering that in the limited time that we have. So yeah, turning to recent success stories, just wrapping things up quickly from in the interest of time. This slide summarizes fintechs in Indonesia which have achieved success, and by that I mean those which have achieved unicorn status. What's worth noting is that one of the fintechs here on this list, Bukalapak, had previously established operations in Australia via the establishment of a technology hub. And here at Gen Advisory, we would love to support other Indonesian fintechs who have similar aspirations. So turning then to the last component of this section, looking at the regulatory opportunities, the market and regulatory opportunities and challenges and opportunities in Indonesia. As we can tell from everything we've talked about, and it should come as no surprise to the people in this audience, Indonesia, is almost a mirror image of the Australian market. On the one hand, from the regulatory perspective, it is one where the regulatory environment is still undergoing changes and is still so compared to Australia, it is one which has a relatively higher level of regulatory flux, I would call. I use the term relatively because even in Australia, there is a degree of regulatory change, which is constant, right? So compared to the Australian market, it does have a higher level of regulatory volatility. And at times, there are challenges in terms of the differences between the practical implementation and what the legislation states in practice. And the counter argument, the flip side to that is, Indonesia and OJK has made significant progress. The Indonesian regulators have made significant progress in terms of the enhancement of their regulatory framework, and we see that as a opportunity for foreign fintech coming in the future. In terms of market challenges, as stated before, in terms of transaction sizes, we do see they are typically of a smaller size than you would of lower average sizes than you would see in Australia what you see in Australia. It's less of a B2B market as compared to Australia, relative to Australia. But in terms of opportunities, it should come as no surprise. Indonesia has a substantial unbanked and underbanked segment of the population that is of interest to foreign fintechs. What is possibly not as well known about the Indonesian market is that it has a rapidly growing middle class, and because of that, there is a rapidly growing business to consumer market that's highly attractive. And relative to the Australian jurisdiction, in our view, Indonesia offers significant direct business to consumer potential. Now we have come to the end of our time allocation. I apologize. It's clear. I apologize for the IT challenges that we've encountered in this webinar. So from all of us, thank you, Andrew and Clement. Thank you for your participation support today. Paul, thank you if you're listening, thank you for your support as well. And look forward to speaking further with all of you. Thank you all.